Canaccord Genuity's managing director George Gianarikas was on Yahoo Finance talking about Tesla. He continues to believe that there's been an overcorrection to the downside. He then emphasizes again the three catalysts that will re-energize Tesla stock: the coming next generation vehicle ramp, margin recovering and increasing as adoption for full self-driving grows, and the continued rapid growth in energy storage. We've got Hans Nelson joining us. He has his own YouTube channel, Hans C. Nelson. You should check him out. Thank you so much, Hans. Appreciate you joining me.
Thanks for having me, Herbert.
So George Gianarikas of Canaccord is still one of the bulls, and he is acknowledging that there is a slowdown and margin compression, but he's still very bullish, thinks that Tesla is going to get past through this. The question is timing. So let's watch a little bit of his comments, and then we'll pause it and get your thoughts on it.
Well, first, let's address the reason why it's lagged. And it's pretty simple. The numbers have come down. I mean, if you look at the earnings revisions for the last 12 plus months, they've been terrible. I mean, I think we started for 2023 somewhere early in that year on $6, and it came all the way down to $3. And I think we're at a period of time right now where the worries likely exceed the reality. And we had some numbers last week come out of China that weren't very good, but those people didn't take into account that the new year has been pushed into February. Also, some stuff that happened in Germany. Their plant came down for about a week because of arson, a week plus. And in the U.S., people are worried about the production of their new Model 3. And we think that the best way to kind of gauge, for the most part, what's happening with Tesla, particularly in the U.S., is to look at their prices. And they've been pretty stable in the U.S. over the last few months. So, there's a lot of wood to chop still in the quarter, but in the near term, we think that we may have overcorrected here to the downside.
They talked on their most recent earnings call, George, about the spending and some of the record R&D that they had done during 2023, which now places a lot of emphasis on bringing that to fruition in 2024 and years following now. How much of that spending do you anticipate will lean further towards the side of this artificial intelligence narrative that has started to prevail with Tesla, even though we've seen some early slippage this year, at least in the price action?
Look, we're in a little bit of a pause period right now for the stock. In the near term wiggles, we think we've overcorrected, but for the stock to really get its legs, we have to have three things happen. First, the next generation vehicle has to start to ramp, or people have to gain confidence that it's going to ramp and be successful. Second, their margins need to go up. And the most likely lever for that happening is the increase of FSD, full self-driving penetration, which leverages the AI that they've built, in addition to volumes starting to pick back up. And third, it's continuation in growth, really good growth in their energy storage business. So when you talk about leveraging this R&D that they've spent a lot on, it's two real products that come out of that, the big spending. It's number one, that next generation vehicle, which we think should start production in the second half of 2025, and continued FSD penetration. Now, we think that the FSD offering from the company at $12,000 currently is a little too rich, particularly relative to the cost of the vehicle. We think the company should cut the price of that FSD to really increase penetration and really have the margins start to turn in. If you think about it, that offering is about 100% gross margin, very, very high gross margin because it's a software upgrade.
Okay, let me pause it there, Hans. So quite a number of things to talk about. First of all, do you agree that the stock today is overcorrected, that the sentiment and the valuation of the stock is overcorrected to the negatives that people are looking at Tesla?
I guess it really depends on an investor's time frame. As a long-term investor, I think it's definitely very attractive prices for someone to be entering in right now, especially since the sentiment is so negative overall. I would just urge people to have a little bit of caution, though, here, because some of these catalysts that he's looking to really turn the story around, can continue to take another 12 to 18 months to play out, if not longer, potentially for like FSD, for instance. Is it possible for FSD to really increase its functionality and for Tesla to work on improving its penetration in the next 6 to 12 months? Yes, it is possible, but I would say that that's probably unlikely. I certainly wouldn't want to be making any short-term investment decisions based on that possibility. But the story is, very much driven by the fact that EPS estimates have been shrinking. And if we look more at some of the fundamentals of the business, as long it really, I think, boils down to what is the macro environment going to be. As long as the U.S. doesn't enter into a recession and that consumer spending on vehicles overall remains at least flat to positive and doesn't trend downward, then I think pricing in the US should remain at least consistent to where it is today, if not rising. And then costs will be going lower. And so we should see margins beginning to re-expand. And once you see that margin expansion begin, then that really takes the wind out of this fears about just EPS amounts that are continuing to shrink all the way down to zero, from now forward, which really take the wind out of the sails of the stock. And so I would totally agree from that perspective.
Yeah, perfect. I agree. So of course, he talked about recovering margin. I do like that he, again, an institutional analyst, actually giving some value to FSD, that's expected to improve and then had 100% margin to it. And I think we're hearing more and more and more of these institutional analysts recognizing that FSD, this is not Robotaxi, but just as version 12 comes out and the story gets a little bit better, that people feeling stronger, more people will do the uptake of that. And then, of course, the energy business. So that part, he actually mentioned it. And that one is, few people can argue that is a real deal material. And in fact, they're underestimating that. So he mentioned that. Yes. And then I agree with you. The next gen platform maybe is a little too early. It's certainly a catalyst, but it may not happen for at least a year longer. So let's listen in to, did you have a comment? Yeah.
I was just going to say, he did mention that it's really confidence in next gen that is what we need to see. So we don't actually have to get all the way there for sentiment around next gen to really actually begin to have an impact on the market price. And I would agree with his point there. And I do love his recognition that it's the penetration of FSD software that he's looking for as a driver of revenue, not kind of skipping ahead to the Robotaxi future. And I agree with him that that's the right thing to think about. I do think that analysts oversimplify a little bit. They think that all that Tesla needs to do is lower the prices to increase penetration. And while technically that's true, that would happen. I think at this point in time, Tesla's not satisfied with the level of safety that FSD beta is capable of. And so they're not going to do that while the status of the software isn't good enough yet. But I think we're rapidly moving towards the place within, potentially the next 12 to 24 months where that will be the case. And once Tesla does feel very confident about the safety, I do personally expect them to significantly lower the price, increase the penetration, and that you could double, quadruple, quintuple the amount of FSD SaaS revenue that the company is bringing in close to overnight. And that type of turning on the tap of just new revenue that is flow through directly to the bottom line, like new earnings just materializing overnight, that will be a very large driver of a parabolic upward move for Tesla, the stock.
And a redefinition of margin for an auto company. Completely redefinition of it. Love your points. Fantastic. Okay, let's listen then to the rest of his interview.
George, we have seen, though, the price wars play out. Obviously, Tesla, far from the only automaker, one of many, I should say, that has been forced to lower the prices, obviously putting pressures on margins, very similar to what you were just saying. How do you see that, more broadly speaking, beyond Tesla, shaking out just a bit, and that pressure to the downside in terms of boosting demand? How much longer are they going to be forced to slash prices in order to drive the demand that we simply have not seen?
Well, look, there's been a pause, like I said, recently, particularly in the U.S. The price declines that we saw for the most part in 2023 is sort of ebbed right now, which for us is an indication that maybe things aren't that bad. And what the company did strategically by being that aggressive is, first of all, they get to sell more vehicles, right? Because interest rates went up and most people financed the purchase of their vehicles. So that meant that the prices of vehicles went up artificially. But second, it put a lot of their competitors on their back legs. I mean, margins got a lot worse for some of the pure play EV competitors. Sales got a lot worse for them. And even for the traditional OEMs that try to compete against Tesla, their margins got significantly worse because they couldn't compete with Tesla on price. So what we saw is, longer term, what Tesla did is put a lot of its competition on the back foot, particularly in the United States and Europe.
And so let's talk then about China, because that's one of the larger kind of lingering risks right now for Tesla. Is sentiment shifting so much in the region that there would be a longer term implication for how Tesla is able to operate and sell into China as well?
That's a great question. I mean, look, we see the real competition for Tesla long term. Look, we really like Rivian in the United States and in parts of Europe and other parts of North America. But in China specifically, there's some very, very good OEM competitors, some pure play EV companies. The company has one plant in China right now, able to produce about 950,000 vehicles. And they're running, despite this monthly volatility, they're running full tilt there. And we continue to believe they'll run full tilt in that country. So there's really good competition in China, but we think Tesla can operate that factory at relatively full capacity that leaves them in a good place in that country.
So, George, as we wrap this up, we started this segment talking about the share price being under pressure. We're trading around $179 a share today. What more specifically does that upside look like?
Look, our price target is in the 230s, and we base that on 26 times our 2026 estimates. And we think that's going to happen as volumes start to pick up next year and the year after that, based on increased Cybertruck production and the next generation vehicle. And importantly, we think that the margins will start to get better, particularly as we've seen an abatement in price reductions, at least for now, and costs continue to come down for the company. So, in the near term, we have these wiggles, and we think, like we said, we've overcorrected to the downside in the near term. But, for real outperformance, we need next generation vehicle or some visibility to that, increased margins based on FSD mostly, and continued growth in their energy storage business. Those three things will really get the stock to get its outperformance legs of old back.
I like that. When he's talking about, like, just think about 24 months from now, or 12 months from now, I'm sorry, 1 year from now, yeah, the world's going to look very different for Tesla. Right now, it looks dire, gloomy, but 12 months from now, it's going to look pretty good, don't you think? What do you interpret what you heard there?
Yeah, I would say that I really appreciate commentary of this quality from a Wall Street investment analyst. George seems like he's pretty sharp and has his finger on the pulse very well here. So I would agree with what he said. And he made this point, and I'll just reiterate it, that Tesla really was making these price cuts from a position of strength. So the other thing, they mentioned Tesla's competitive position in China. And I would say for anyone who has concerns about that, I would highly recommend that they actually go back and watch the long form interview that you did with Michael Dunn here a couple weeks ago. That was an incredible conversation that gives investors like us who are from, a Western country and don't necessarily have good visibility and access to information about what the Chinese market is like. Michael Dunn is very deeply embedded in that world, highly involved with GM China for a number of years, kind of as that was getting off the ground, and then did a bunch of consulting work for other automotive companies that were trying to ramp up operations there. And basically his point was that Tesla is still even the best auto manufacturer in China, that yes, the automakers like BYD and a number of other Chinese competitors have taken up the call, and they are producing increasingly good quality vehicles, that really Tesla is kind of in the lead position as far as a company that's there operating in China, able to make highly profitable products. And then the other piece that adds into that is that while there are other Chinese automakers who are trying to solve the full self-driving piece, personally, I wouldn't put any of those players ahead of Tesla. And so as long as Tesla is able to deliver on FSD, and if the regulation in China allows for it to be used there in China, which all indications at this point say that it will, then that continues to actually put Tesla at an advantage, even in the Chinese auto market, which is the most competitive auto market in the world. And if they can win there against Chinese auto manufacturers, then it's really automotive manufacturers in the whole rest of the world that need to be worried about these Chinese competitors, not necessarily Tesla.
Wonderful. Thank you so much, Hans. That was great. Nice to listen to George, his points, and then your commentary. Thank you very much. Follow Hans on YouTube, Hans C. Nelson. I've created a website that is the most comprehensive resource for the Tesla investor. Please check it out. Simply go to my website at herbertong.com.